Okay, let's unpack this. We have gotten our hands on a stack of absolutely fascinating writings from a legendary investor. Letters spanning from the late 1950s all the way through the mid-1990s. And these aren't academic papers. They're his practical, in-the-trenches observations and fundamental principles shared directly with his partners and later his shareholders. It's decades of wisdom laid bare.
It's a truly unique window, isn't it? These writings capture the development of an investment philosophy in real time across wildly different market conditions and business environments.
Yeah.
You can really see the core ideas solidifying while strategies adapt to scale and, changing opportunities, like a masterclass in evolving your approach without abandoning your principles.
And our mission here is to navigate through this material, pull out the absolute most valuable insights, the practical nuggets you can actually use today to understand how this thinking grew, and what remains timelessly true about business and investing. We're aiming to give you a shortcut, sort of, to seeing the world through this particular lens, straight from the source. We have a lot to cover, so let's jump right in.
Okay, let's start at the very beginning then.
Yeah.
Late 1950s, early 60s. Right away, you see a core idea about performance relative to the broader market.
Right.
He notes explicitly that performance is likely to be better in bear markets than in bull markets, which the 1957 and 1958 results mentioned seem to confirm.
And the reason for that is so telling, isn't it? The focus wasn't on predicting what the overall market was going to do at all.
No, not forecasting.
The entire effort was devoted to finding undervalued securities. So in a strong bull market where prices are high, the simple goal was just to keep pace with the averages. Think about that.
Yeah.
When everyone else was chasing huge gains, their goal was just to match the market. That completely flies in the face of today's typical FOMO culture. What does that discipline tell you, about focusing purely on value, even when it feels like you're missing out?
It highlights the fundamental difference in approach. And early on, there's a stark warning about market psychology.
Oh, yeah.
A widespread public belief that stock profits are inevitable could, he warned, lead to eventual trouble.
Right, the bubble mentality.
Exactly. Even if the intrinsic value of a solid business isn't affected by that kind of sentiment, its stock price certainly could be if the bubble bursts.
Makes sense. And this early period saw investments fall into two main buckets, right? Special situations and generals.
That's right. Generals was really just his term for undervalued securities.
Okay.
Take the Commonwealth example for special situations. They managed to sell their large block at $80 a share when the general market quote was, 20% lower.
Wow.
It's an illustration of finding opportunities where you can realize a profit somewhat independently of the daily market price, though he acknowledges the timing of such profits is often fortuitous. It requires finding a situation with a defined path to unlocking value.
Got it. And the generals.
These were companies available at very cheap prices simply because they lacked glamour or anything pending, just boring but cheap.
Okay.
The critical element here was finding a substantial excess of value over the price paid, creating that all-important, comfortable margin of safety.
The margin of safety, key concept.
Absolutely. And the diversity of these commitments, he noted, offered both safety and appreciation potential. It's interesting, too, that he felt timing purchases was more effective than timing sales.
Really? Why is that?
Well, finding the bargain seemed more controllable than guessing the top. And they were content selling at an intermediate level towards fair value, not trying to squeeze out the last nickel.
That patience, again, willingness to leave something on the table, it's a recurring theme.
Definitely. And on the subject of timing, there's a strong admonition from this era about performance measurement.
Ah, yes, the short-term results.
He stressed that 6-month or even 1-year results are not to be taken too seriously because they exaggerate chance fluctuations. The opportunities available dictate the portfolio mix in any given short period. It's largely determined by the accident of availability.
The 1962 results illustrate this, perfectly outperforming significantly when the market dropped, but then falling right alongside the Dow later in the year.
Exactly.
He used this to show how actual results can deviate substantially from what you might expect in the short term, even if your underlying analysis is sound.
Yet, despite that short-term noise, the long-term ambition was clear: to achieve a significant annual advantage over the Dow, ideally 10 or 15 percentage points.
Which sounds huge.
It is. And there's that powerful table included in the letters showing the enormous effect of compounding even small percentage differences over time.
Oh, I remember that. The gulf between like 4% and 16% over 30 years is just staggering.
Exactly. It drives home why achieving even a modest, consistent edge over the major investment media was the entire point of the partnerships, that compounding is everything.
Right. And finally, from this foundational period, there's a very practical piece of advice. The importance of objectively evaluating the accomplishments of the fellow who is actually handling your money, even if it's you.
Yes. He calls this self-assessment of enormous dollars and cents importance. It forces honesty about what's working and what isn't. Crucial.
So thinking about this early, disciplined focus on value, the margin of safety, and ignoring market noise, how does that mindset translate to finding opportunities in today's world, maybe even outside traditional stocks? What does that early focus on just matching the market in a bull run teach you about the true goal of value investing?
Well, moving into the mid-1960s and 1970s, we see a significant evolution. The letters detail a dramatic shift in the landscape for finding those early quantitative bargains.
Yeah, it got harder, right?
Much harder. Fewer understandable securities were available in decent size that met their demanding performance criteria. New ideas were becoming scarce, maybe only a few a year.
And he points to several reasons for this shift. The market environment changed. The partnership itself had grown significantly.
Which makes smaller opportunities irrelevant, yeah.
And there was substantially more competition. More analysts, more active combing for bargains, and takeovers targeting the very types of undervalued companies they sought.
Right. This virtual disappearance of the bargain issue, as determined quantitatively, forced an adaptation. A big one.
How so?
He notes the best chance for large profits now came from occasional security, where I am really competent to make an important qualitative judgment. He even mentions recent good performance was due to a single idea of this sort.
So a critical pivot point moving beyond just the number.
Exactly, to assessing the intangible quality of a business and its management. It's not just about cheap anymore.
And this period saw the introduction of a third category, control situations.
Yep. This is where they would either control the company or take a very large position and attempt to influence policies. He stresses these require a several years perspective for evaluation, as stock prices might not move much initially while they are acquiring shares and, implementing changes.
And the acquisition of Berkshire Hathaway itself is the prime example, isn't it?
Absolutely. Starting in 1962 at $7.60 a share, the price reflected prior management losses. By buying enough stock, it became a control situation, allowing them to step in and change the direction.
And remember Dempster Mill, one of those early undervalued generals.
Oh, yeah, that became a major turnaround story in this period.
In 1962, they brought in Harry Bottle to address severe managerial problems. The source quotes him calling Harry the man of the year.
He really turned it around, detailing how he cut the break-even virtually in half, sold off dead inventory, revamped marketing, got rid of unprofitable facilities.
It's a powerful illustration of how the right management can unlock value even in a tough situation.
Definitely. But it's also important to note that this wasn't a smooth upward trajectory. He's very upfront about difficult periods.
Like when?
Mentioning the poor 0.89% return on workout investments in 1967 due to concentration risk, and the challenging 1969 results where they were, frankly, lucky to be in liquidation mode as their continuing investments performed poorly in that market.
That mention of liquidation brings us to the context of the late 60s and early 70s when the partnership was actually wound down.
Right. Assets were sold, cash returned to partners, with just a few significant holdings like blue chip stamps remaining.
And amidst all this, the early 1970s letters also offer some interesting insights into the bond market.
They do. He observed historically unusual conditions where passively investing in tax-free bonds was fully the equivalent of hiring a professional to manage stocks, which is quite a statement.
Yeah. And there's a discussion on how inflation erodes purchasing power and impacts bond yields, and comparing stocks versus bonds based on after-tax return.
He also highlights the volatility of bond values tied to interest rate swings and maturity length, and points out the inherent unfairness of call provisions.
Where the issuer can call the bond back early, usually when it's bad for the bondholder.
Exactly. But he also details the specific attractiveness of discount bonds, those with a low coupon bought below their face value.
Why were they attractive?
They offer higher gross yields and a preference for current return. And crucially, the 1969 Tax Reform Act pushed banks out of this market, potentially giving individuals an edge.
Interesting. Finding opportunity by understanding market structure and regulations.
This is a great example of that.
That's fascinating how they looked for those structural edges. So thinking about this evolution, how does changing market behavior or increasing competition force your own search for value to adapt? What does that shift from pure quantitative bargains to needing a qualitative judgment tell you about the kind of research that becomes necessary as obvious opportunities dry up? And what can that Harry Bottle story teach you about spotting potential in struggling businesses?
Well, moving into the late 1970s and 1980s, with the partnership wound down and Berkshire Hathaway becoming the main vehicle, the focus shifts to scaling capital and deepening the economic moats around acquired businesses.
Right, building durability.
The core belief is reiterated.
Mm-hmm.
Intrinsic value will grow substantially over the years, estimating around 10% annually. And while market prices fluctuate at great amplitudes around intrinsic value, he's confident value is virtually always reflected at some point in a market price over the long term.
And the emphasis is powerful. Think of your holdings as businesses, not stocks.
Exactly. This period also saw the insurance business become increasingly central, a really attractive area to employ capital.
National indemnity and the like.
Right, providing substantial and profitable reinsurance and direct underwriting. And he introduces the concept of the insurance cycle.
Yes, the ups and downs.
Periods of deteriorating rates leading to underwriting losses, followed by an inflow of business at compensatory rates as the industry hardens. Navigating this, he stresses, requires managerial discipline, meaning being willing to shrink volume during the soft, unprofitable parts of the cycle. Don't chase bad business.
Got it. And then there's float. This is a critical concept, he explains.
Absolutely critical. The money held by insurers, but not yet owned prepaid premiums, reserves for claims not yet paid.
And the underwriting loss, if any, is the cost of float.
Correct. The business is profitable if this cost is less than what you could earn by simply borrowing those funds elsewhere. GEICO is highlighted for having an effective cost of considerably less than zero over time. Huge advantage.
He also points out that accounting quirk, right? Carrying bonds at cost.
That amortized cost, regardless of market value, which really tied up insurers' capital and options when bond prices plunged in the 70s and 80s, made them look less impaired than they perhaps were economically.
So this era is really defined by successful acquisitions of enduring businesses with strong underlying economics and great management.
That's the magic combination. Look at See's Candies. Earnings grew significantly, $4.02 to $12.06 in pre-tax from 72 to 77, in an industry with no unit growth and little additional capital investment.
Amazing.
He stresses the combination of an excellent product and the genuine affection for the customer, personified by Chuck Huggins. Brand power.
Then GEICO, described as the best of all investment worlds.
Because it paired a very important and very hard to duplicate business advantage, those rock-bottom operating costs, a 23.5% ratio in 86, with extraordinary management.
And he highlights how the value of retained earnings is directly tied to the skill of the management team deploying that capital.
Precisely. The Washington Post newspaper is noted for its strengths. A news-rich mixture, the discipline to maintain large news holes for reader value.
Space for news versus ads, yeah.
And overcoming industry challenges like rising costs through focused management and circulation efforts.
In Nebraska, Furniture Mart, Mrs. B. The core strength there was its exceptionally low-cost operation,
which allowed them to offer best values, driving huge volume and stocking an incredibly broad inventory, like 10 times larger than a typical competitor. He celebrates Mrs. B's energy, even at 92, and the Blumkin family's acumen, just relentless focus on cost.
Fetchheimer and Borsheims are presented as similar examples where the magic is in the management, right?
Exactly, allowing them to succeed even in an inherently less attractive industry economics through low-cost operations and high volume. Management overcoming structural disadvantages.
Seeing all these successes led him to formalize the acquisition criteria by 1987 for the big purchases.
Over $10 million in after-tax earnings, yeah.
Demonstrated consistent earning power, no projections or turnarounds needed.
Very important. No wishful thinking.
Good return on equity with low debt, strong management already in place, simple businesses they could understand. No complex tech.
Keep it simple.
And requiring a sensible offering price.
The last one's key, too. Price still matters.
He also dedicates significant discussion to how standard accounting practices, GAAP, can often obscure the true economic reality of a business.
Oh, yes. For example, the undistributed earnings from major investees like GEICO or Washington Post didn't show up in Berkshire's reported operating earnings, which he felt diminished the utility of the single-year measure of economic performance.
You weren't seeing the full picture just from the bottom line.
Not at all. And the amortization of purchased goodwill, especially as the accounting rules changed, affected reported earnings, but had nothing to do with the business's actual economic value.
Right. It's an accounting fiction in some ways.
The blue chip merger example illustrates this. The true economic cost was higher than the book value being reported.
Proportionate redemptions where a company buys back shares were also seen differently.
He saw them as equivalent to a dividend in substance, even if the accounting treatment differed. These were special, beneficial transactions that might not be immediately obvious on a standard income statement. You had to look deeper.
This scrutiny of capital deployment extends to a critique of stock buybacks versus corporate acquisitions.
He explains the significant benefit of repurchasing their own stock when its market value is well below its business value, calling it easy to get $2 of present value for $1.
Which sounds like a great deal.
Compared to typical corporate acquisition programs, which he states almost never do as well, buying your own cheap stock is often the best acquisition.
He also points out a lack of skill he observed in many CEOs when it came to capital allocation.
Calls it a critical job where errors are no small matter, given the substantial amount of capital deployed over time. It's maybe the most important CEO job.
And there's that famous critique of EBIT earnings before depreciation, interest, and taxes.
Calls using EBIT as a measure for debt servicing ability delusional because it ignores necessary capital expenditures, the C.
The money you have to spend just to stay in business.
Exactly. He stresses you must consider C as it often exceeds depreciation, B, and it's essential just to maintain the business's competitive position. EBIT ignores reality,
Bonds are revisited in the late 1980s.
reinforcing an aversion to long-term bonds due to concerns about the U.S. currency's future value and the trade deficit. Medium-term tax-exempt bonds served well during this period as a safe alternative to holding cash, though.
And this era saw interest in convertible preferred stocks and large non-controlling blocks of shares, like with Cap Cities or Salomon.
Right. These offered ways to deploy significant capital with specific terms that blended elements of both fixed income and equity potential, a different kind of opportunity.
Wow, that's a packed period. What can you take away from seeing how they identified and nurtured businesses with that strong combination of economics and management? How might you apply those formalized acquisition criteria to analyze companies you might be interested in? And what does that deep dive into accounting versus economic reality tell you about the importance of truly understanding what's happening within a business beyond the standard reports?
Well, moving into the early 1990s, the letters reflect on the challenges and principles of managing a now massive enterprise. Size is explicitly acknowledged as a significant disadvantage for deploying capital effectively.
Yeah, the law of large numbers kicks in.
Finding a $370 million idea to have the same proportional impact as a $1 million idea years ago makes it, in his words, a tougher job than it was.
Yet, they still found opportunities. The WPPSS bond purchase, for example, high-yield, unrated debt that became investment grade, is mentioned as a large, specific situation that worked out about as expected.
Shows they were still looking for those unique situations. Arbitrage activity, though, a feature of the earlier partnerships, was noted as reduced due to the increase in large, long-term equity positions. Less focus there.
And there's a clear emphasis on wanting Berkshire's stock price to consistently reflect its business value, actively discouraging speculation driven by significant overvaluation as significant undervaluation.
Right. He wishes for very little trading activity among shareholders, viewing them ideally as partners in a private business who understand its long-term value, not just traders.
Their conservative financial policies, particularly maintaining low leverage, are framed as a critical safety margin.
Even if it might have led to slightly lower returns on equity in hindsight compared to taking on more debt, it was deemed the wise approach given potential volatility and the long-term perspective. Sleep well at night factor.
He repeatedly stresses the crucial role of the superb core of operating managers. These are the people who get extraordinary results from some ordinary-appearing businesses.
Uses the Casey Stengel analogy, getting paid for home runs the other fellows hit. And many of these managers stayed on long after their businesses were acquired, deeply attached to the companies they ran.
This attachment leads to that deep-seated attitude within Berkshire, an unwillingness to sell businesses, even if a tempting price might mean earning an extra 0.5% a year.
It's fascinating. He explains this isn't just sentimentality. It's about valuing the relationships and friendships, with these managers. Selling is a price we don't want to pay just to make a bit more money.
Which is really countercultural in finance. He presents this unique aspect as part of what you buy with Berkshire stock, highlighting the non-financial value and character of the management team.
It's a huge part of the culture.
That's a powerful statement about prioritizing relationships over marginal profit. And this period brings perhaps the clearest definition of the core investment target, a franchise versus simply a business.
Yes, the definition is very clear. A true franchise has three characteristics. 1, it has no close substitute. 2, it faces no price regulation. And 3, it has the ability to price aggressively and earn high returns.
And crucially,
a franchise can even tolerate some mismanagement and still do okay. Coca-Cola and Gillette are used as examples.
whereas a business
Only earns exceptional profits if it's a low-cost operator or has exceptional management. It cannot tolerate mismanagement.
big difference.
The search, he concludes, is for large businesses with understandable, enduring, and mouth-watering economics that are run by able and shareholder-oriented managements, essentially searching for the superstars.
That mouth-watering economics phrase really sticks with you, and he revisits the market for bargains, contrasting the new issue market
Where sellers control the timing and few bargains exist.
with buying in the public market, where shareholders selling for various, sometimes irrational reasons can offer shares below their true business value.
Scott Fetzer is highlighted as a great example of a business achieving excellent earnings with very little equity capital.
How so?
Because they required minimal ongoing investment in assets, they could funnel over 100% of their reported earnings back to the parent company, Berkshire. Super efficient.
He also takes time to praise the quality of Berkshire's shareholders.
Specifically, the consistently high level of intelligent owner-related questions asked at the annual meetings. He valued that long-term owner mindset.
Accounting changes in 1993 are noted.
Regarding goodwill amortization and securities valuation, again stressing they impact reported earnings, but not intrinsic value. He maintains that Berkshire's book value, while an underestimate of intrinsic value, still serves as a useful tracker over time.
The value of float is revisited, too, in the context of falling interest rates.
Right, lower rates mean the cost of float has to be lower than in prior decades just to break even. Required a combined ratio of maybe 102 versus 107, 111 before. It impacts the attractiveness of the insurance business somewhat, unless underwriting is consistently profitable.
Risk is explicitly discussed, challenging the academic concept of beta.
He states his belief flat out. Stock risk is not divorced from long-term business risk. The competitive strength and endurance of companies like Coke and Gillette truly matter, even if their stock might have a similar beta to a far less resilient business. Business risk is the real risk.
Finally, in the context leading up to 1996, the creation of the B stock is explained.
Ah, yes, the baby Bs. The goal was strategic, to offer a low-denomination product far superior to Berkshire-only trusts that were popping up.
Sort of parasitic funds.
Essentially making those clones unmerchandisable. It was aimed squarely at attracting investment-oriented shareholders who understood the value, avoiding those who didn't, or were just chasing price momentum.
And he expresses a clear dislike for typical IPO structures that create first-day pops.
Preferring a market price that reflects underlying value from the start. No games.
And the letters touch on succession planning with stock designated for family and foundation and the underlying structure of Berkshire.
Designed to require little continuing intelligence in corporate headquarters, though acknowledging the main manager's ongoing critical role in capital allocation. He ends this period by reiterating the deep value placed on working with people they like and admire. It comes back to culture.
That's quite a journey, isn't it? From bargain hunting to building this massive conglomerate based on enduring franchises and, really, relationships, how do the characteristics of a true franchise help you identify businesses that are truly resilient, that can withstand challenges?
That's a key takeaway.
What does that deeply ingrained attitude of not selling businesses, even for profit, tell you about the kind of culture that creates long-term value, not just for shareholders, but for employees and managers, too? And how does the creation of the B stock show a strategic focus on attracting the right kind of investor for the long haul?
Reflecting on these decades of insight, it's quite a story. We've traced the foundational principles of value investing, witnessed the necessary adaptation to changing markets and increasing scale, seen the absolute centrality of exceptional management in driving success in both great and challenging businesses, and explore the development of a unique culture built on trust and long-term partnership with both managers and shareholders.
It really is amazing how many of these ideas, forged in decades past, remain incredibly relevant today, even as the world and the company's scale have changed so much.
They really do.
From the early hunt for hidden quantitative value to understanding the power of insurance float and the enduring moat of a strong franchise, there's just so much practical wisdom distilled in this material.
Exactly. And it consistently ties back to that objective evaluation of performance, the unwavering focus on intrinsic value over market price, and the discipline to be patient and wait for the right opportunities, even when they are few and far between, for a large pool of capital.
So what does all of this mean for you, the listener? How does thinking about businesses as enduring entities with specific economic characteristics, looking critically past standard accounting numbers, and prioritizing management quality change how you evaluate opportunities, whether it's a stock, a private business, or even, I suppose, your own career path?
Good questions. And finally, here's something to think about. Given the acknowledged difficulty of deploying ever larger sums of capital effectively, and the stated preference for businesses that require little ongoing capital investment just to stay competitive during inflation, what might the future look like for capital allocation within a massive, successful enterprise built on these very principles? Where do you put that much money to work while staying true to the core philosophy? That's the ongoing challenge.